Welcome back. I found a video recently on social media that highlights how banks work and how they keep people in not a strong financial position. Let's jump right in. This is from John Clark and Brian Daw, and it talks about how banks work. And this is just a portion of the video, and I found it on a YouTube channel by Bryce Tonkin. So here we go.
Well, I'm a bank, Brian, and I borrow money and I lend it out, and I charge more to the people I'm lending it to than I pay to the people from whom I'm borrowing it.
Well, who do you borrow money from?
Well, from, depositors, Brian. Have you got a dollar?
Well, yeah,
I
sure.
borrow your dollar and I give you, there's your bank balance.
$1.
$1.
Right, okay, and you pay interest to me on that?
I do, but I also charge you fees.
Well, why do you charge me fees?
Because, Brian, I'm looking after your money. Your money is secure with me. I'm a bank. This is a very important amount of money. This is probably your nest egg. It's safe with us.
And how much interest do you pay me?
Approximately the same as I'm charging you in fees.
Oh, good deal for me.
Well, your money's secure with us, Brian, and I then lend that money to businesses, and those businesses generate income. This is how we build an economy.
Yeah. And they put that income into the bank?
They do, of course, Brian, and that builds the savings pool, and we can invest more money.
Well, who do you lend that to?
Trend here.
Well, to people who need credit, Brian. You see, money creates more money, so if we can create money that creates more money, we're broadening the economy, we're expanding it all the time. Yes.
But shouldn't people just buy the can afford?
You don't need to afford the things you're buying, Brian. You need to afford the interest on the money you need to borrow in order to buy them.
And you're charging higher rates for all this?
We do hop into them a wee bit on the credit rate, Brian. We stick the hydraulics under that because it's a slightly higher risk strategy.
Do people need to be buying these things that they can't afford?
Obviously they think so, Brian. These things are advertised to people as very necessary, very important and deeply, deeply attractive.
Well, who's advertising things that people don't need?
The companies we're lending the money to.
So, okay, then you bought into the US subprime housing.
Okay, so let's stop it right there because it's going to get into a whole different avenue. And what you find, though, is the banks have a great system for making money. They take our deposits, then they lend the money out at a higher interest rate to businesses. The businesses then generate product that people need to buy, and a lot of people, and this is true in our economy, a lot of people finance the products that they want, that these businesses are selling. So the cycle of debt becomes something that keeps us from being able to create wealth. If you want to be wealthy, you need to understand a few different things. First one is, and this is very basic and very minuscule, and it won't make a huge impact on your financial life, but it will make an impact. Shop around for your bank. The skit, and this is a skit, this is not a true conversation between bankers in case anyone had any misconceptions about that. But the truth about banks is a lot of the big banks will charge fees that are pretty close to what you have in your bank account, unless you have a very large bank account. But there's a lot of different options for you. There's credit unions or smaller banks who don't charge much in fees. They don't pay much in interest either, but they don't charge a lot in fees. So you can put your money in, you can get a little bit of interest, you don't have the fees, and then the next step is to not go after the non-bad debt. So in my mind, there's good debt, and good debt is something that you can buy with debt like a rental property that will generate additional income for you. So the good debt pays for itself. The bad debt keeps you broke. And that's a broad stroke, but like a car loan. A car is buying a depreciating asset. If you can pay cash for a car, you don't have that ongoing expense. If you have to finance the car, you're paying money plus interest on an asset, on something that we call an asset, but it's depreciating. So it becomes more of a liability. So what this bank skit talks about is they're trying to continue extracting money. And then he has this little statement real quick that sounds like someone very sophisticated, and I hear it all the time, where they talk about you don't need to afford the item you're buying, you only need to be able to afford the debt on the item that you're buying. Now, a good example of how that's not working currently is look at the national debt for the United States. The United States has a significant amount of national debt because we're spending more than we're bringing in, and the interest is becoming more and more of a burden. If you ever known anyone who bought a car, a lot of times, who financed a car, many times people who finance a car are very excited when they buy it. They've got several $100s a month, they can easily afford it, they think. 3, 4, 5 years down the road, as that loan is getting more and more mature and the car is getting older and older, they're now a slave to that loan, or they're stuck with the payment on that loan. That loan controls a certain percentage of their income, and they don't have that available to do something else, in addition to all the other expenses that are now coming up. So when people get sophisticated like this, a lot of times that's where they get in trouble. For example, I saw someone who worked for an investing firm years ago who talked about generating returns and arbitrage, and what they did was they took out a second mortgage on their house, put that money in the stock market thinking they could generate a 10 to 20% return on it because that's what they taught every day. What happened though was the market took its first downturn in a number of years and they were unprepared, unable to service the debt, and they lost their house. So when we try to become more sophisticated by utilizing debt on non-positive assets, non-income generating assets, especially if it's a risky scheme, we may or may not be able to turn it, and that risk bites more people than it helps. So the other piece is being able to afford the debt. That can be a tricky scheme. Again, focus on good debt versus bad debt. Focus on turning the bank's business model into your business model, and you'll be able to be successful. So what does that mean? If you were able to take your money and put it into investments that generate a return as opposed to servicing debt for someone else, if you're able to invest in the stock market, if you're able to invest in income property, if you're able to start a side gig that generates consistent income without debt, these are all factors that will enable you to build wealth and kind of turn the bank's business model on their head, only utilizing banks to save your money while you're deciding what investment to go into. I hope this has been helpful. If it has, please give us a like down below. If you like this type of content, consider subscribing to the channel. And if you know someone this may benefit, please share the video. Thanks for being here. We'll see you on the next one.